Another element of the volume profile is this thing called VPOC, or volume point of control. It is the single highest point of volume in the profile. So if you're looking at a 3-month profile, doesn't matter, 1-day profile, every volume profile is going to have a point where there is the most volume. And that's going to be volume point of control. And it's very similar to a high volume area. It's the highest volume area for any given time frame. And it's kind of like home for price. When price fails higher, it moves back to VPOC. Typically, Matt. It doesn't always have to be that way. But when price fails lower, again, it typically will return. When sellers fail to push price through a low volume area to the downside, and they get stopped out to the upside, they're usually going to wait until another price. They're not just going to, typically, they're not going to re-engage and try to, take out these buyers who just took them out, right? They're not going to re-engage. If you're a seller and you just got stopped out by buyers, what's your first thought? Well, if I'm going to sell again, I'm going to find an area above to sell, right? That's your thought, because value for a seller is going to be higher once they get stopped out. So the volume point of control, once that happens, is the most likely place where sellers would begin to re-engage because it's a fair price. So sellers start to believe that they can make money at VPOC. They've proven it. So it becomes home. Fair price, I told you, it acts as like a price magnet. And it's why in a volume profile, the high volume areas, or VPOC, act as phenomenal targets. Remember yesterday when I was looking at the ES, and maybe you don't remember, but 23.50 was the VPOC, and price had just moved up beyond a low volume area. And I said, this would be a long, and I said my first target would be 23.50. And I actually said at that point I was looking for 32, at least 32 on the day, because of the way the auction didn't finish last Friday. We got the 23.50 and the 32 and beyond. But all of that was because I understand that if sellers are failing to the downside and they get taken out, I can see them pushing, they get taken out, they are likely not going to re-engage until at least someplace they consider to be fair price. And that first place is going to be volume point of control for a specific price distribution. Does that make sense? What's important for me in all of this is that you start to understand, relative to the auction, what happens behind the scenes. So again, when you hear things like, well, support becomes resistance, resistance becomes support, you understand what's really happening between buyers and sellers, and it's something that you can see as evidence in the print. Because sometimes what will happen around a low volume area, especially on the ES, and especially in the last year and a half, maybe a little longer, on the ES, sellers have typically been nothing more than contributors to buyers. So what I saw, in fact, 2013 was a tough year at the beginning of the year, around March, and on through the rest of the year, as we really started moving higher in the ES. Because what would happen is there would be a low volume area that was established to the upside. Price would come up, and I would see the opportunity. The print would give me a signal, right? I would see weakness at the offer, strength coming in at the bid, and normally in a market you get some level of rotation, you get some level of pullback, just because participants are managing their inventory that way. And what would invariably happen is I would get into the trade and sit there and watch the print, and I could see the activity coming in at the bid. I would get a couple, 1, 2, 3 ticks, and that was it. Buyers were holding the bid up at the low volume area, at the high of the low volume area, and then they would they would push through with this incredible amount of volume to take the stop, grab the stop, and then price would come right back down, and my trade would have worked. And I can't even tell you, at the beginning of 2013, when you expect rotation, you don't get that rotation. I don't think I've ever seen more stop runs in my life as I saw in 2013 and through the first half of 2014. And what we're going to do in this course is identify in the volume profile and in the print, if you're in a trade, you've taken an opportunity for a short or a long at a low volume area, what you can never do is know if you're going to get stopped. If you're long, you are never going to know if there's going to be a big push by sellers just to go grab those stops. Could happen, could not happen. It can't keep you from your trades, right? You still need to take your trades, but we're going to identify things in the print that are, and we've already talked about a few of them, that are automatically going to tell you, oh, this is at risk, I need to do something. Or I just need to simply understand that my loss is going to be these 4 ticks or 5 ticks. And the great thing about this is I'm going to show you using the volume profile and the print what is a stop run. And I don't mean just using the stop run analysis. I want to show you in the print, what does a stop run look like? Where is it most likely to happen? And it's most likely to happen around a low volume area. And what does it look like in the volume profile and in the print? Because once you get a stop run, let's say you're looking to go long and they sell into in towards your stop and they buy back and take price back above that low volume area in a hurry, I want you to be able to get back into the trade, because the level is still likely a good level, but you can't avoid those stop runs. And you can't move your stops thinking that, well, this might be a stop run, this might be a stop run. So the other thing we're going to do is identify what does a stop run look like in the print and in the volume profile, so that you can effectively get back into a trade if that's what happens to you. But also, when is a move through a low volume area likely to be an ongoing move? When are we likely to get continuation? It's a real move. What are the things associated with that move through a low volume area that tells me this is a legitimate move and I either have a short or a long opportunity? A couple quick questions here. Do I follow RTH profile or Globex or both? I follow, when I'm trading the ES, I will typically start a new profile at the beginning of the session at 9:30 Eastern. I use the Globex profile as a reference point similar to opening and closing swings. I'll use it as a reference point. So in the overnight, in the Globex session, I will get low volume areas and high volume areas. One of the things that I do, especially with the opening swing, if it's within range, and it is within the Globex, I am looking to see if an opening swing high, let's say it opens lower, the ES opens lower. I'm looking to see if the initial push on a move higher in the ES, for example, if the opening swing lines up with a Globex low volume area. If so, then I have some additional confluence that that's a key level, and it starts helping me build my story, which is the context of the market. So I do use both of them. And once I kind of get into, once the day starts progressing and the RTH session shows that the Globex sentiment is not valid, I really don't pay any attention to the Globex anymore, because I know that in the RTH session, 80 to 85% of the overall volume comes in, and it's likely just going to run over anything that was there in the previous Globex session. So would I consider the high and low value areas unfair price? I would consider not necessarily value areas, right? And we're going to talk to value areas here in a bit. Not necessarily value areas. We can get action off of high and low value areas, but I don't necessarily consider them to be fair price. And we'll go through value here coming up. In fact, here we are to value area. I can see my presentation is a little slower than what's on my screen. So, so the next element of the volume profile, and so far we've talked about volume bars at price. We've talked about price distribution, that bell-shaped curve. We've talked about the high volume areas, low volume area, and volume point of control. The next one is the value area. And the value area is pretty simple. It's a function of VPOC, always a function of VPOC, volume point of control, and represents one standard deviation, or 68.2 to 70% of the most volume from the VPOC. So it's easy to understand how it's calculated. Volume point of control represents the most volume, most price, most volume at that price. And then it simply takes, finds the next area or price that has the most volume, and above and below, and 68.2 or 70% of the overall range. It identifies the 70% from volume point of control that represents the highest volume bars. That becomes value. And the thought behind value, just so you understand, and this is way old school, but the thought behind value and the 70% is that in any given time, in a total range of a market over a specific period of time, it is likely that 70%, if 70% of all transactions happen in this range, then the market considers that the value of that range for that time. So it's a function of VPOC, and it's, let's just say 70%. 70% of the highest volume bars from VPOC. So sometimes you'll see VPOC towards the bottom of the value area. Sometimes you'll see it at the top of the value area, and sometimes you'll see it in the middle of a value area. And given where VPOC is relative to value range, it tells you something. So if VPOC is at the top of value, it tells you that above VPOC, there wasn't a whole lot of interest. And the majority of the interest for prices was below VPOC down to value. So that tells you that that market is somewhat bearish for that day or that time frame. If, however, VPOC is at the bottom and most of the value area is above VPOC, then that tells you that that market is relatively bullish because the majority of volume occurred above most fair price. And that may take a little bit to make some sense, and you're going to have to see that a couple of different ways. But based on where VPOC is relative to value, it starts adding to the story. All of this information I'm giving you adds to our story of answering the two questions. What is this market trying to do, and how good of a job is it in doing? How successful is it doing its job? By the way, on the ES, I know it's come down. I'm still looking for that 31.75, 32 level today. Anyway, so that's value. And I'll show you why I'm looking for it specifically. In fact, when we get into a couple of slides here, and I gotta move it along. When we get into a couple of slides here on the different structure types of the volume profile, I'm going to show you the structure of the volume profile from yesterday and why I am specifically looking for 30, 31, 75, 32 today. All right. So the next one, the last one, is this thing called the finish. Remember the example I gave you of the Super Bowl tickets and how when price starts moving up, there are less and less participants? Well, the volume profile, like I said, is very visual. And on every volume profile, what I'm going to show you is how the market finishes in the volume profile. And what it is it's not always the final end of an auction, but it's an end of the auction for that point in time. It's saying we're done down here, we're done up here, we may revisit it today, but right now we're done. And if price revisits the end of an auction and you start getting volume, volume always means acceptance. You start getting volume where an auction had finished, that gives you a significant amount of information about what buyers and sellers are doing. So the finish is that tapered end of the profile that shows participants leaving the auction. And I'm going to show you examples of that. So let's take a look at the attributes. I'll go through this a little bit quicker. Some of this, I don't want to be repetitive, but I want it to be effective. All volume, principles of the volume bars. It's all volume that's included. That's for every executed contract, every order executed at each price. It's the amount of volume at each price that shows interest in executing orders, again, at all prices. When there's less interest, there's less volume. When there's more interest, there's more volume. If price is going down and there's less interest, as seen by the profile, you know that you can begin looking for evidence in the print that the other side is stepping in, and voila, you have a long opportunity. The next one is the principles of the volume point of control. It's the most fair price. So we may have in a profile several high volume areas, but the volume point of control is the most fair price in a profile. It means that when price fails at an extreme, either to the low, the downside, or to the upside, it is most likely to go back to VPOC, which is the most fair price. It's the point from which value is derived. Therefore, VPOC can shift. VPOC can move in a day. And if VPOC moves, it tells us something. And it's indications of direction of value and price. So if we start in a day and we start a profile and we have VPOC at 1923 and price starts moving up and the profile now shows a shift in VPOC to 1926. One of the things I want you to get as just an automatic response, just like you stop at a red light, you stop at a red stop sign, make this an automatic response. Where there is volume, there is typically acceptance. There is acceptance. So when the volume profile starts building out and the VPOC shifts, what is that? That is telling you that you have acceptance higher. And then you're watching the print because that's where you can take a breakout. You get acceptance higher and you see the print coming through, you're typically going to be able to take a breakout and watch the price continue to move in that direction. It's different across time frames, daily, weekly, monthly. So I could have a daily profile, a weekly profile, a monthly profile, and I would have different volume points of control. Remember, I give more weight to the most current context. The next element is this bell-shaped curve or price distribution, these zones. And remember, volume increases as participants enter the auction because they see fair value ahead. And to the other side, volume decreases as participants decide to leave the auction because they don't see additional value. And we see that in the amount of volume, and it shows profile. Now at the high point, the high volume area, because both buyers and sellers see value at and around these high volume areas, they are both willing to participate at that price. So they are both engaging in buying and selling. And because they both believe that they can make money, they are engaging. They are actually making market orders, both short and long. And that belief of fair price causes the higher volume. And as price moves away from fair price, fewer participants believe that they can make money. So we see the volume shrinking. That's why we get this distribution. That's why we get this bell-shaped curve. And what's cool is I'm going to show you this in different markets. The principles of the high volume area. They represent fair price where buyers and sellers are willing to trade. Because it's fair price, we expect price to rotate, right? Both buyers and sellers are active. When both buyers and sellers are active, we expect what? They're going to buy. Those buyers are going to become sellers. Price is going to come down. Those sellers are going to become buyers. And price is going to rotate typically around a high volume area and VPOC. If that does not happen, so if price comes back to a fair price or VPOC and it does not rotate, it is a very, very strong market signal to us that price is not only going to move in the other direction, but it's going to put at risk the next low volume area, either higher or lower. So let me give you an example. If price is coming down and it hits a VPOC or a high volume area, and sellers can't get it through that level, and buyers hold and start taking price back up, what that is inherently telling you, remember, high volume areas act as fair prices. So you would expect to see sellers engaging at the high volume area or at the VPOC. If they do and they cannot get price through that level, it no longer will become a fair price. If sellers are telling you, I don't have enough or we don't have enough conviction short to take price through what is considered right now to be fair price, then trust me, when price moves up into that unfair high, that low volume area above, it is highly probable that price is coming through that low volume area. Because why? Because buyers or sellers are going to look for a different area before they start engaging. And that different area is the high volume area above. It's also why when price comes through to the upside of a low volume area, I will look to take a long on a retest and look to take the trade back to the next highest high volume area. Fair prices, high volume areas act as magnets when price gets rejected either above or below, because the auction will facilitate trade back to high volume, back to volume. It is a fundamental job of the market to facilitate trade. And if the market is doing a poor job of facilitating trade represented in volume, it will move price back to a point that it will facilitate trade, which is a high volume area, because that is the job of the market. High volume areas can often provide excellent target areas for trades. So if you want to get more out of your trade, don't look at where price is. Look at where it's likely to go, especially if the print is confirming. All right, next one. Principles of the low volume areas. Low volume areas are unfair highs and lows where buyers and sellers typically do not want to transact business. They typically have one or two effects on price. Either moves away, kind of bounces off like a brick towards the direction it came, or it moves through as a spike of volume and moves towards a new fair price. Either way, price typically moves away, right? Low volume, the market's job is to create volume. At a low volume area, price is going to move away. It's either going to move away quickly to the other direction or move through very quickly. If it does not, so for example, if we have a low volume area, and this happens a lot in the day time frame, we have a longer term low volume area, and in the day we are getting, it shows us as a high volume area. We're getting VPOC, we're getting rotation around that low volume area. It speaks volumes about what to do, more importantly, what not to do. And what not to do is to trade. So when you have a longer term low volume area and in the day time frame, price is rotating around that, and you can see in the day volume profile a high volume area or VPOC, you sit on your hands, because what it's telling you is you have a battle at typically an unfair high or low, and one of those sides is going to win. You do not want to be trading in that battle. Trading up against unfair prices provides excellent risk-reward opportunities. And let's take a look at the principles of the value area. Again, it's calculated from VPOC, and therefore VPOC will always be inside of value. Technically, it's one standard deviation. 68.2 is the technical number. Most systems use 70% of the total volume to either side, higher or lower, of VPOC. Therefore, where VPOC is in the value range is very important. So if VPOC is at the top of the value range, that tells us something about the structure and the interests of the market participants. If it's at the bottom of the range, it tells us something as well. Again, it's all building a story. We look to the print to confirm that story, and we get into trades. And we have a lot of confidence because of the market structure and things like where VPOC is relative to value of what is most likely to happen with buyers and sellers at specific levels. If price moves away from value, one of two things happen. Value is either going to continue to follow price, and there'll be most likely acceptance, a new fair price, maybe a VPOC shift, or price is going to return back to value. And then most likely, if price gets rejected, it's going to return back to the high volume area or VPOC. And finally, this thing called the finish, principles of the finish, it's the physical evidence in the volume profile that the auction to one side may be ending. When I say may, it's because especially in a developing auction, there are times when the auction is developing, you can see on the profile, buyers or sellers are stepping away, doesn't matter which side, and then buyers or sellers will re-engage in that area, and they'll open up the auction again. But that's a good thing because it tells us a lot about the conviction levels of those buyers and sellers. It can be used with order flow print to determine if aggressive volume to one side is in fact going away, and new volume on the other side of a finish. So let's say an area looks like it's tapering off, and let's say to the downside, it looks like sellers are going away, buyers are coming back in. If sellers re-engage and we start seeing a lot of activity back to the bid, that gives us a lot of information about the conviction of the sellers. And if they re-engage that area and that auction continues further down, that gives us a lot of information about the strength, or more important, weakness of the buyers and the strength of the sellers. All right, so it shows us a potential end to an auction. And somebody had asked me about scalping with this system. When you have a finish, and we're going to see this in a couple of different examples, a finish to an auction, and you have a print, let's say a finish to the downside, the print goes weak at the bid, strong at the offer. You want to talk about great scalping opportunities. It's that. When you have a finish and price is starting to turn around, it will usually go a point or 2 points, and depending upon what you consider to be a scalp, and you'll have a pretty good trade. So that is the volume profile elements and fundamentals. Oh, settlement price is 32. Yeah, you're exactly right. I'll show it. Yep, you're right, and that would be one reason why I would consider for price to go to 32 today. Not because it's settlement, but that is, when I talk about confluence, that is perfect confluence to what else I'm looking at in the market, and I'll show you what I'm looking at here as we kind of get through this. So that is the elements and the fundamentals of the